VOO is often called the gold standard of index investing. It is simple, reliable, and gives you instant ownership of 500 of America's strongest companies. For millions of investors, it is the only fund they will ever buy. And to be honest, it has earned that reputation. But here is a truth that most people do not realize until it is too late. VOO alone might actually be slowing you down. It is not because the fund is risky or broken, it is because it is incomplete. VOO gives you stability and growth, but it leaves out two critical ingredients that accelerate wealth: dividend income and global opportunity. Without those two pillars, your portfolio might look great during a bull market, but it is not working as hard as it could to get you to financial independence. The answer is not to sell your VOO shares. The answer is to build a fortress around them. In this video, I'm going to show you the hidden risks in the S&P 500 that no one talks about. I will also reveal the two powerful funds that fix these blind spots. By the end of this journey, you will see exactly how to combine these three assets into a strategy that fits your specific stage of life, whether you are in your 30s, your 40s, or 50 and older. So no matter where you are today, you will know exactly how to protect your family and retire with peace of mind. But first, let us take a closer look at why VOO became the favorite and where it starts to fail. To understand the power of the S&P 500, we have to look back at the 1990s. The American economy was booming and the internet was changing the world. Tech companies were soaring and the market felt unstoppable. Then, in the year 2000, the dot-com bubble burst. Investors who were heavily concentrated in tech saw their life savings vanish almost overnight. Yet, through that chaos, the companies in the S&P 500 held the ground. These were businesses that actually made products, generated real profits, and paid dividends. That is where VOO draws its strength today. It owns the backbone of the American economy. Over the last 10 years, a $10,000 investment in VOO would have grown into over $33,000. It is efficient, with an expense ratio of only 0.03%. That means you are paying practically nothing to own the greatest success stories in history. Companies like Microsoft, Apple, and Amazon. But here is the catch. Today, nearly 40% of VOO is concentrated in just 10 companies. Most of those are in the technology sector. This means when those few giants stumble, your entire retirement plan stumbles with them. That is called concentration risk. It is invisible until the market turns red. If your goal is to reach retirement faster, you cannot just hope that 10 companies carry you there. You need to amplify your growth and secure your income. That is where our first missing piece comes in. Meet the Schwab US Dividend Equity Fund, or SCHD. This fund does what VOO does not do. It focuses on high-quality, cash-rich companies that have a proven track record of paying you every single month. SCHD does not just chase high yields. It screens for financial health and consistency. It owns companies like Home Depot, Chevron, and Pepsi. These are mature businesses that keep making money even when the economy slows down. What makes SCHD special is that it pays you while you wait. Its dividend yield is more than triple that of VOO, and over the last decade, those dividends have grown by over 10% per year. When you reinvest those dividends, you are buying more shares that generate even more cash. This is the cycle of compounding that turns a small spark into a massive fire. It cushions your portfolio when the market gets shaky, because while stock prices go up and down, a solid dividend is a blessing you can count on. But even with VOO and SCHD, there is still one more blind spot. You have built a strong wall inside the United States. But what if the next wave of growth happens somewhere else? History shows us that the U.S. market does not always lead the way. From the year 2000 to 2010, the S&P 500 basically went nowhere for an entire decade. During those same years, international markets in places like Europe and Asia quietly took off. If you only own American stocks, You are betting your entire future on one single country. To fix this, we add the third piece of the puzzle. The iShares International Equity Factor Fund, known as INTF. This fund gives you exposure to global heavyweights like Nestlé and SAP. These companies operate in different currencies and different economic cycles. When the U.S. market cools off, another region often heats up. INTF also provides an extra layer of income with a dividend yield of nearly 3%. The best part is that there is zero overlap between this fund and your American holdings. Every dollar you put into INTF is working in a completely different lane. Together, these three funds create a portfolio that is both efficient and truly global. Now that we have the tools, let us talk about how to use them. The right mix depends on where you are in life and what you want your money to do for your family. Let us look at 3 different strategies for 3 different ages. First, imagine a young professional in their late 20s named Josh. Josh has time on his side, which is his greatest asset. His strategy is the foundation portfolio. He puts 30% in VOO, 30% in SCHD, and 40% in INTF. This gives him a heavy dose of international growth and early dividend compounding. If Josh invests just $10 a day, his portfolio is projected to surpass $1.3 million by the time he retires. That would generate $7,000 a month in passive income, all from the price of a daily lunch. Next, consider someone in their late 30s or 40s named John. John wants balance because he has more responsibilities now. His plan is the core growth strategy. He leans 40% into SCHD to increase his steady income. He keeps 30% in VOO and 30% in INTF. John is focused on growing steadily without the stress of market swings. Finally, we have James, who is in his 50s and is looking at retirement very soon. James cares most about preservation and reliable cash flow. His approach is the income and stability strategy. He puts 50% into SCHD for that heavy dividend cushion. He keeps 20% in VOO and 30% in INTF. This mix is lighter on volatility but still diversified across the world. Each of these men is following the same core principles: diversification, discipline, and patience. They are not guessing or gambling. They are using a proven system that covers every angle. Retirement is not just about a number on a screen. It is about the freedom to decide how you spend your time. It is about the security of knowing your bills are paid and your future is protected. The first million is always the hardest because you are doing all the heavy lifting. But once you reach that milestone, the machine starts to run on its own. Your dividends reinvest. Your global assets grow. And suddenly, the second million arrives much faster than the first. This is the power of a complete strategy. If you are currently only holding VOO, do not be afraid. You have a great foundation. But remember that a house needs more than just a foundation to protect a family. It needs walls and it needs a roof. SCHD and INTF are those extra layers of protection. Start where you are today, even if it is only a few dollars a week. Consistency is the key that unlocks the door to independence. You have the map and you have the tools. Now, all you have to do is take the first step. Your future self and your family will thank you for the choices you make today. Thank you for watching and for trusting me on this journey. I look forward to seeing you in the next chapter of your financial freedom.